What is going on, guys, and welcome back to another very exciting video. In this video, we are going to be taking a look at one of my favorite companies in the stock market right now, and that is Google or Alphabet, whichever you prefer. Google has been beaten down in a very significant way in just the last couple weeks, and it's starting to get back to very interesting valuations. So what we are going to do in this video is we are going to take a look at their free cash flow and calculate their free cash flow yield based off the current stock price. And then at the end of this video, what I want to do is I want to address a couple concerns that I have with Google. There's a couple things going on that kind of make it similar to Meta in the sense that I could see the stock market selling off Google in a very massive way if some of these fears become more widespread throughout the market around Google as a company. So we're going to get into all of that in this video. If you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at Google's chart. What we can see is over the last 5 days, the stock is down 7.7%, which is absolutely a massive move for a company with a market cap of $1.21 trillion. And the stock has a high over the last 5 days of around $107.64 and has traded all the way down to around a low over the last week of $94. And that from high to low is almost a 13% move downward. Not only does a large downward move obviously impact the stock price, but the other thing that impacts is the forward PE ratio. So what we are seeing right now is Google is sitting around a 17.64 forward PE ratio. And compared to around a year ago, we see that Google was sitting at a 25.71 forward PE ratio. So right now we are getting Google at a discount compared to where it's traded in the past. Not only is Google trading at a low valuation compared to itself, it's also trading at a low valuation compared to the S&P 500. Right now, the S&P 500 is trading at a 19.97 forward PE ratio. Let's go ahead and jump into the free cash flow analysis. The first number that we need is the number of shares outstanding for Google. And what we can see right now is as of February 2023, Google has 13.018 billion shares outstanding. And then obviously we need the free cash flow. So the free cash flow we have here on Yahoo Finance, I always cross-reference against a couple different sites and make sure that the numbers are looking correct. So what we have is for 2022, they had $60 billion in free cash flow. Then for 2021, $67 billion. For 2020, $42.8 billion. And then for 2019, $30.9 billion. And we can cross-reference those numbers with macro trends. So macro trends right now, again, $60 billion for 2022, $67 billion for 2021, $42.8 billion for 2020, $30.9 billion for 2019. And then we also want to pull this number from 2018. So that is $22.8 billion for 2018. Now that we have all those numbers, we can throw them into this calculator and come up with a free cash flow yield. So let's just break this down. Over here on the right, we have the free cash flows. So in 2018, the company had $22.83 billion in free cash flow. In 2022, it had $60.01 billion. Then we can take those 5 years and average them. And what we come up with is a $44.73 billion free cash flow. We build in a margin of safety of 10%, and that gives us a $40.26 billion free cash flow. And then at the very top, we have shares outstanding. So that is 13.018 billion shares outstanding. And what we are doing is we are manipulating this free cash flow yield until our market cap and our price per share get to where the current price per share is at and the current market cap. So right now, Google is sitting around 1.2 trillion in terms of their market cap. And that's what we have about right here. And then our price per share is currently around $95. And again, we are around $95. So that gives us a free cash flow yield of around a 3.25%. 3.25% is around average for what you see with companies. You kind of like to see anywhere, around 4 to 5% is relatively good. But what's more important is looking at their forward free cash flow. So where could the company be headed in terms of their free cash flow? And what we want to do is we want to look over the long term and see how Google has grown their business, over time. So what we could see is in 2009, they had a free cash flow of $8.5 billion. And then we are going to compare that against their 2022 number of, again, $60.01 billion. And when we compare those two free cash flows against each other, we see that Google has a compound annual growth rate of around 16.21%. So what we can do is we can manipulate the numbers and project the free cash flow growth over the next 5 years. With that compound annual growth rate, what we can do is we can project future free cash flow growth. So what we have here is in 2022, 2022, again, Google gave off around $60.01 billion in free cash flow. And what we are doing is we are compounding that by 16% year over year for the next 5 years. So by 2026, we are projecting that we could be at $109.45 billion in free cash flow. The numbers over here, we are keeping basically the same. So the average free cash flow from those numbers, we are getting $82.88 billion. And with a 10% margin of safety, that gets us down to $74.59 billion. Again, we want to match the current market cap and the current share price. So it's around $95 and the market cap is around 1.2 trillion. And what that gives us is a 6% free cash flow yield. In my opinion, 16% is kind of a high number. So what I've done here is I put in a 10% growth of free cash flow. And what that gets us is still a relatively high number of 5.3% free cash flow yield for Google. So again, in my opinion, you do need to look at these numbers and determine what you are comfortable with. I think 10% is a lot more realistic. Building in, that margin of safety into your free cash flow is important. Not only this margin of safety that we are calculating directly from free cash flow, but also your compound annual growth, because the higher compound annual growth you have, that is again just going to create that compound snowball effect. And a lot of these business cannot just infinitely grow. Google has gone through a major growth cycle over the last 10 years. And is it going to go over that same cycle over the next 5? Probably not as likely, not as high of a compound growth rate. So that is where, in my opinion, a 10% number is a lot more realistic. A 5 to 6% free cash flow yield is excellent moving forward. But what we need to consider is some of the risks with Google. And the comparison I drew at the start of the video is Google compared to Meta. These two businesses right now have been purely software-based businesses. Google has obviously built out some of their Pixel business, their phone, and then also the Google Chromebook. But other than that, they do not have a whole lot of hardware. When you compare these two types of businesses to Apple's and Microsoft's, where they have a lot better integration with hardware, they provide their own hardware, then you start seeing some of these discrepancies. Because what could happen, and what we've seen, with Apple stepped in and kind of started regulating all of their platforms. They started putting what people call the Apple tax of 30%, just to have an app on their app store. And that creates issues because basically now you're reliant on these other players to allow you to be successful in the marketplace. And Google could run into a similar situation. If Microsoft starts stepping up and basically regulating some of these other businesses, regulating potentially Google search from not being on some of their devices and similar things like that, then you could start seeing issues with Google's free cash flow. And clearly Google does recognize this risk. We could see on their website, they have phones, earbuds, watches, smart home, laptops, and other accessories. They are doing and trying to integrate a lot of their technology into hardware, and that is going to be an important next step. They need to start integrating a lot of this technology and kind of take over that part of people's lives, because when you are only purely online and you do not control the devices, how people connect to online, then you are at a disadvantage to some of these players like Microsoft and like Apple. With all of that said, I just want to point out some of the risks. Make sure you are not buying a stock just because some random guy talked about it on the internet. Make sure you are doing your own due diligence and looking into these companies on your own before you add them to your portfolio. So I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.